Hey everybody, good to be here today. My name is Brent Moore. It's time for Advanced Option Strategies. If you've been with me the last several weeks, you know we've been going through kind of a series of different option strategies of when you'd use them and pros and cons, and we're going to continue that series today. Here we're going to do a little variation on a, a trade, a basic trade, but I think the variation is actually the more popular trade, to be very honest. In other words, today we're going to be talking about skewed butterflies. And this is going to sound this is a little bit anecdotal, I guess, but I would say the traders I know probably trade skewed butterflies more than they do just the plain old vanilla butterfly spread that they do. And I'm going to show you why here in just a little bit. But before I do that, I do need to go through a few important things. One, hey, if you're here live, you can participate in the chat. James is in the chat. Appreciate James, of course. And, between James and myself, we'll try and get your questions answered there. Okay, so that's the first thing. Second thing, you can always follow James or myself on X, formerly known as Twitter, at Brent Moore CS, at James Boyd CS for additional financial content throughout the week. Also, remember, we're talking about options today, and options do carry a high level of risk and are not suitable for all investors. The material today is intended for general informational and educational purposes only. And, what that means is that we'll all be showing trades, but they're not recommendations. They're just practice. They're example trades is what they are. And so just to educate you, short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And paper money software application is provided for educational purposes only. That's what we'll be using today, the thinkorswim desktop software. And let's see, all investing involves risk, including risk of loss. There's no guarantee that execution of a stop order will be at or near the stop price. So keep that in mind. And past performance is no guarantee of future results. Probability analysis results are theoretical in nature, not guaranteed, and do not reflect any certainty of a degree of certainty of an event occurring. Schwab does not recommend the use of technical analysis as the sole means of investment research. And I'm not going to factor in commissions today in the trades, but just realize they are a real thing, commissions and fees. All right. So I saw someone mention the Mag 7 there in the chat. Appreciate you on that. I appreciate all your comments. Yeah, you can kind of see here right now what's, Amazon, Alphabet's doing good. Apple's doing pretty good. Microsoft's doing pretty good. Not so much on NVIDIA, but NVIDIA had its day in the sun yesterday where it had a good performance yesterday. In fact, if you look here, you can see these are kind of like the chip stocks here for the most part there. Those are just not a good day for chip stocks there. But, so that's kind of the mix in the market right now. And if we look at the S&P 500 as a whole, we're trending up on the S&P 500. A little bit of a bumpy ride. If you want to smooth out the ride a little bit, you can look at the SPXEW, the equal weight. That's a nice trend up, isn't it, on that equal weight? Some of the smaller companies there are kind of smooth out the volatility of some of those bigger companies we just mentioned. But what I would say is it appears to me, if we're looking at like the SPX, that we're kind of just like bounced off a level there. That's be kind of a key support level. That we're hanging with that 20-day moving average, though. That's what that red line is. The general trend is up. And, it goes to a broader point. Very often in this webcast, we talk about some neutralish trades, calendar spreads or iron condors or butterflies or neutralish trades. But probably very often in the market, when you're looking at a stock, you're probably not just neutral. You're probably not like the stock's just going to go sideways. Very often you're going, well, it could go sideways or maybe down a little bit, or sideways or a little up a little bit. And that's where this trade that we're talking about today is going to come into play. So we're talking about a skewed butterfly spread. And what I want to start off with is not a skewed butterfly. I'm going to start off with a traditional butterfly spread here, okay? So with the traditional butterfly spread, this is on Citigroup, okay? And what you have is you have two contracts at a middle strike, okay? 133 is the middle strike here, and then $5 below and $5 above. So equidistant, I have a long contract and I have a short contract. Excuse me, I have a long contract and another long contract. Okay, the two short contracts. Notice there's two short, one long up here, one long down there. That's your balanced butterfly. The distance or equidistant butterfly right there. That's how that is. And when you do that, the graph is nice and symmetrical, right? You could draw a line right down here and it basically is the same on the right and the left. That's what a normal butterfly looks like. Okay, and just another point, I want to look at this graph. I'm going to zoom into this graph in just a little bit, in just one more point, but it's a positive theta trade, as most neutralish trades are. This is a negative vega trade, kind of like an iron condor in that regard. But that's kind of what it looks like. But let's do this. Let me go down here and just pull this up. And I want to point out something to you. As soon as let's go September, let me just switch my date here, okay? I want to point out something to you here on this, and that is one of the knocks, if you will, I guess, one of the challenges with that traditional butterfly is this. It's right here. Now, probabilities aren't guaranteed, but that's a lower probability trades. Here's our break even. Here's our break even on this. About a 30% chance it's at break even or better. Well, those aren't great odds. Okay. Now, there's some good things about it. Okay. So one of the bad things is they tend to be, I mean, we can change it depending on strikes and stuff like that. They tend to be lower probability. That's the bad side. Okay, that's not good. They tend to have a pretty good return on risk. If you were to measure it from the max gain, here's the max gain right there. Difference between max gain and our this is our break even right here, and versus our max loss, which is say right here or right here and there. So, so return on risk, check. That's kind of cool. Lower probability, not so cool there on that. So that is what a traditional butterfly looks like. But I'm going to tweak it just a little bit for you here. Let's just tweak this trade here. Let me go up to, I'm just going to change one of these strikes here. And I'm going to just kind of shimmy it down. 137. Did you see the change there? Let me just close those strikes down. I changed this strike. Look at that graph up there. I'm going to change it a little more. Oh, look at that. It changed more. You see how it's skewing? Let me do one. We'll do one more. Okay. We'll do that. Now, when we do this, now, if I'm looking at that probability, set slices, break even, expiration. Now, hey, we're not really the probability of break even or better, 59%. That sounds a lot better than the 30% that we were talking about before. Our max gain is here. It's not like, I don't know, this looks to be roughly 1-to-1 return to risk, maybe. I don't know. Sometimes it'll be better, sometimes it'll be worse than 1-to-1, but that's kind of not terrible. And if the stock goes up, now the odds of hitting this right here are pretty slim, I got to admit, but as you look at this, you go, well, look, if it goes way up, then I'm still making some money. It's not a max gain by any means. It's not that, but I'm making some money. So I've made this a neutral-ish to bullish trade on that. Okay? So let me just do this. Let's look back at that chart. If you're neutral-ish to bullish, then that may, that's the wrong chart. Let's go to Citigroup. If you're neutral-ish to bullish, then maybe that trade would make sense for you. Okay? Now, when you have this, you can skew it, and what I'm going to suggest you do is you play with the strikes to have something that fits the bill here. Okay, so I just wanted to start off with that. But let me just kind of summarize the initial thing. A normal, regular butterfly, equal distance strikes. A skewed butterfly, we're going to tweak them up. A normal butterfly, usually, not always, but usually decent reward to risk, but a lower probability. Okay, positive theta, negative vega. Let's look at a different example. Okay, and so let's look at one that maybe you're a little bit more directional on. Okay, are we a little bit more directional on this? Maybe, you know, hey, this had a pretty strong trend. JP Morgan here had a pretty strong trend, and that's kind of one of the key things we look for typically as technical investors. It showed a little weakness. We kind of broke that 20-day, but overall, I'm going to say kind of neutral, kind of bullish here. Kind of neutral, kind of bullish. Look, if your forecast is different, then you want to do this trade. But let's do kind of a neutral, kind of a bullish trade. But the thing you need to know when you're doing these, the first thing you're looking at is this. What's the zone you think the stock is going to go to? What's that target zone? So for example, if I think, hey, you know, we kind of have support here. This is kind of a, you know, near term. I'm going to go near term here, shorter term. I'm going to say support, resistance. I'm going to say kind of in the middle here is where my target zone is. But I'm going to say the trend is decent on this, and it may go above that, so I want to open it up in case it goes up more. And of course, if it goes down, that's not great news. Well, you know, there's always some risk on some trade, so you need to have some area on that. So what I'm going to do is I'm going to say if my target zone here is 360, then I'm going to look for a 360 strike as kind of the middle. That's the approach I would suggest. I don't care what stock you're looking at. If you're considering a skewed butterfly, well, actually, for any trade, know where you think the stock is going. That's the first thing you got to do is know where you think the stock is going. And you may be wrong, but at least you got to have that kind of hypothesis of what it's going to do. So in this case, it's we're saying 360. Okay. So let me clear this. Let me go to the Analyze tab and not do Citigroup. Let's do JPM. Okay. There's JPM. I'm going to go to Add Simulated Trades. And I'm going to go to the weekly contracts, September 21st. I have butterfly selected. We said the middle strike was going to be 360. Okay, so here's 360. Now look, whenever you do butterflies, it's going to come in, it's going to give you the middle strike, and it's give you the next strike up and the next strike down. Okay, the problem is almost always they're going to be too close. One strike apart just doesn't work typically here. So, but we're going to click on this, and I'm kind of bullish on this. I'm going to skew a little more bullish, so I'm going to do a call butterfly. I'm going to click on the calls there, and so here's our butterfly spread. And if you look at, let me just move this over. It's pretty narrow. Okay, that's pretty narrow. This is just a typical butterfly. And so what I'm going to do is I'm going to spread it out. Now we said with this, when we were looking at the chart, we said down here is kind of the low end, about 350. Closer to 370 is the high end. 360 is the middle. That's what I'm going to do here on this. Okay. So I'm going to change these strikes to 350, 350 is right there, and 370. Okay. Still balanced. This widens this out. Okay. It widens it out. And then I'm going to skew it. Okay, so here's how you skew. If you're doing, well, it doesn't matter whether you're doing a call or a put, you have a higher strike, you have a middle strike, or two at the 2 times that contract, or should I say -2 because we've sold 2 of those, and you have a lower strike. Okay, it doesn't matter whether it's calls or puts. If I'm bullish, I'm going to move the higher strike a little bit closer to the middle strike. Okay. Or you could move the lower strike a little bit farther from the middle strike. Okay. If I'm bearish, what am I going to do? I'm going to move the lower strike closer to the middle strike, or I can move the higher strike to a higher price. Okay, so just for example, in this case, we said we're a little bit bullish on this. Okay, so therefore, I'm going to take my higher strike, which is 370, and I'm going to move it a little closer to that middle strike. So I'm just going to go with like 365. And this is what it looks like now. Does that seem reasonable? Well, maybe. Let me do my, let's see, that's our right. That's August. I don't want August. I want September 20, let's see, September 19th. And I'm going to set my slices to break even. Now, I neglected to look at what the initial, probability was, but it wasn't going to be great. But here we have about a 54% chance of break even or better. Key points on this. Our middle strike, remember, we set our target zone. Here's our target zone, right there where our middle strike is. Okay, so that's your target strike. We said we want it to be good even if it goes down a little bit. Here, our break even's around 353. And then on the high side, hey, it can go up as high as it wants. We're not making a ton of money here in this situation up there, but we're making something at least. So we've skewed that bullish in this case here. So that gain up there looks like it's about $115 if it goes up past. So if I'm super bullish, maybe it's not the trade for me. But if I'm a little bullish, and look, realistically, you got to think about the time frame. This is a September 18th expiration. We're not planning on holding it all the way to September 18th. We're planning on getting out, 5, 6, 7 days before expiration, about a week before expiration. And so really I've got, we're looking at maybe a 2-week trade. How high is this going to go in 2 weeks? Well, I don't know. I mean, it can go way up in 2 weeks, I guess, but more realistically, I think this is the area we're looking for. Okay? So that's that trade. That's how you do that trade. You can right click and you can confirm and send if you like the trade. And then you can send the trade. But I want to talk about exits on this trade here though, before we go too far on this, and just kind of review before I actually send it. Let's review kind of the, skewed butterflies. Okay. Make sure you know your cost of entry. That initial debit there, that's going to represent the max risk on the trade. Theoretical risk, early assignment, things change and whatnot on that, but that's the risk I want you to consider there. Think about the directional exposure and the probability of this trade, your max gain, but don't put too much weight into the max gain because that max gain is just a little point. It's a little blip on the graph. It's unlikely you're going to hit that exactly. So those are some of those things that I want you to consider here on this. It's nice because it gives you a directional bias. It gives you a higher probability trade, versus the traditional um, butterfly. A little more complex maybe in that regard. You can change the risk. You may risk more by skewing it, no doubt. And just as with any butterfly, there's early assignment risk. You know, anytime you have a short option, there's early assignment risk. Make sure you're looking at liquid options, and there's fees that are gonna factor in. We're gonna start with our price target, that zone I was talking about, and that's where you're gonna put the short strikes there. Okay, and then you can tweak the wings, and if you don't like how you initially tweak them, you can always tweak them more. You can always change it more and to something that you want. Here, we'll look at that. Okay, so compare multiple strikes there and see what you want on that. Okay, now managing. I already mentioned one of those things. One of the management rules here is we're going to exit. I'm just going to say about, in this webcast, you don't have to do this exactly, about a week, okay, before expiration. Before expiry, okay? So we're not going to hold it all the way. The closer you hold it to expiry, the higher the assignment risk is there for you. You're going to exit if we hit where we want, if we're hitting our target zone, okay, basically. If you hit your target zone, you're going to exit. Now, if you hit that target zone in a few days, are we going to be at that max gain? No. Even though it looks like it on the graph, when you're looking at this, okay, when you're looking at this, that is at expiration. Realistically, you're not going to hit that before expiration. Okay. I mean, I guess theoretically it's possible. It's highly unlikely though. So you're not waiting for a max gain. You're not even waiting for 70% or probably even 50% of max gain. If you get 30% of max gain, that's okay. You can take your profit if you hit that target zone. Okay. And then if we have a technical breakdown, that would be another exit, a technical breakdown. So what do I mean by that? What I mean is, hey, we're bullish on this. We kind of had a zone area that we think it's going to be in. And if it breaks down below that and we're no longer bullish and neutral and we just turn bearish, we're going to look to get out. So we have an exit based on time. We have an exit based on if things are going well. And we have an exit if things go south on us. Okay, so we're always going to have those exits on these trades. So if I want, I can, well, I'm just going to send this right now. Okay, I'm going to put this in, well, I don't have groups out right now. I'm going to send, and there we go. So it's thinking here. Okay, now let's look at this. Where would we possibly exit? Well, we could possibly exit if I consider, what if we consider this as a support level on this? Okay, right around 350 or so. If we break below here, maybe we look at an exit on that. And we can always do that. Did we fill this? I don't think we filled yet. Okay, I'm going to cancel and replace this order. And I'm just going to get this, I'm going to just get this to fill here. Okay, let me see if I can send that, send. Okay, so we filled that trade. So what price did we set? We said we were going to exit out. Now we can do this all in one order, and I'll show you in a subsequent trade how we do that in one order. But for now, let's say you already have it in and you want to add in a stop. And we say, well, look, if it breaks down, I don't know, down a little bit below that, we'll say 348, give us a little wiggle room below, maybe about 1% below our support level, then I'm going to get out of this trade. How do I do that? Well, I'm going to locate the trade. And this was JP Morgan. I got to remember here. Okay, so here's the trade. I'm just going to highlight these. I'm going to right click. I'm going to create a closing order. And I'm going to sell out of that butterfly. Now, I don't want to sell out right now, so I'm not going to, I'm going to sell based on conditions. And those conditions are, first of all, I'm just going to make it a market order, good till canceled. I'm going to click on the gear right over here. It's going to bring up a window, and our conditions are below 348. So on this window that pops up, I'm going to scroll down. It just looks blank down here, but it has an area for conditions. Under where it says symbol, you just put your cursor there, click on it, JP Morgan marks less than or equal to 348. That's our exit to get out if the trade goes bad on us here, if it breaks down. Now, we're not going to completely forget about it, because remember, as we get close to expiration, we'll get out. If we start to hit our profit zone, we'll get out. There you go. Okay, let me give you a different example. Here's a different example, because I want to show you that the first two examples I gave you were call examples. Remember, we're going to be looking for, we'll say a target zone, so to speak. So look, here's what I'm going to do. I'm going to go on this chart. I'm going to just say, this has been kind of what we've been doing. I'm going to just extrapolate this line. This is the general trend that we've been doing. Now, I could do a upper channel and a lower channel, but this is kind of where I'm headed. So I'm headed down towards that 560 level. So I'm kind of neutral. I want this trade to be profitable if it just kind of continues to go sideways, okay? I want that to be profitable. I think likely it's going to go down a little bit, so I want it to be profitable there too. And if this continues to really sell off, I want it to be profitable. Maybe not as much, but something like that. And I realize I got to give up something, and if we start to break above resistance maybe, then it's probably going to be a loss at that point. But I'm going to start with my zone of profitability, so to speak, or where I think it's going to go. And I'm going to say, look, if we're between, I don't know, what's that, like 590 or something, and 560, that's about a $30 difference. Let's go with it, okay? So here's what we're going to do. I'll start with the Analyze tab again. We're going to look at, this is Meta. Here's Meta. And I'm going to go to Add Simulated Trades. Of course, you can just add it directly on the Trade tab, but my encouragement to you is learn to use the Analyze tab, because especially on a trade like this, you may want to tweak it a little bit, okay? You may want to tweak it a little bit. I'm going to go, and I'm going to do the same thing. I'm going to go September. These contracts are going to be a little more liquid, typically, the monthly contracts. And we said the middle strike was going to be 560. We're looking at puts because we're bearish, and I'm going to click on that. Now look how skinny that is. What are the odds of that trade? Well, they're not going to be good, so we're not going to do that trade. Okay. Let's go here, and let me set my slices. Break even there. It's not even giving me anything. I don't know why, but it's not even giving me anything. But the point is, hold on. This is just a weird trade right now. Okay. So we're going to separate this out. We're going to go to 590, which is what we said, and we're going to make it equidistant to start. Okay. And when we're going to skew, this is what I always do. You don't have to do it this way, but the way I do it is I start with a balanced trade. 560, 590, so that's a $30 difference, so I'm going to go to 530. Okay. 530. Okay. Here we go. So this is this trade. Now let's set our slices to break even here. See what we got here. Okay. So if we do this balanced traditional butterfly, we're at about 1 in 3 chance. But yeah. But by the way, if you see a trade that looks too good to be true, and what the observation in the chat was, hey, that looked like there was nothing below the loss line on that. If it looks like there's a trade that you can't lose on, there's something you're not seeing. And I suspect in that case, it came down to like difference in bid ask spread of these and the liquidity on that, although I'm not going to take time to investigate at this point here on this. But there's that trade. But we're going to skew it. Now, remember the rules on skewing this. The rules on skewing is if I'm going to skew it bearish, I either need to take the lower strike and move it closer to the middle strike, or I need to take the upper strike and move it farther away from the middle strike. You could do either one of those, same result, okay? But what I'm going to do here is I'm just going to take this, I'm going to make this, I don't know, 535. Well, we skew that a little bit with 535. We still lose if it goes down a lot, okay? We still lose if it goes down a lot. So that's not what I want. So so this is why you play with it. You can make it 540. And now, well, we're not really making much if it goes way down. But again, this is a short-term trade, September 18th expiration. We're going to be out a week before. It says $45 it's a moving target, about $50 or so. Max gain, not max gain, if it goes way down. Well, that's okay. It takes out the risk, a lot of that risk if it goes down a lot. We still have the risk on the upside. But here's the thing. I want to double check. Is this where I think the stock is likely to go, about 560? Okay. Is this an acceptable level of, I think it's going to stay above about 580 in this case? So, and if the answer is yes, we'll look at the chart on that, then we can do the trade, assuming it makes sense. If the answer is no, and we say, well, I think 590 may be more the area where I want to protect against, you know what I could do? I could just shift up each of these strike prices by $10 there, okay? You could shift each of these out. I could make this a 600, a 570, a 550, and this would just effectively make this graph look like that, okay? That's basically what it would look like if I did that, more or less, okay? So are we okay with this? 560 as our main target, 580, if things go south on us, we're willing to put up with that. 560 as our main target, yeah, that's kind of what we're looking at. If it goes down further, that's okay. And 580 as our, it'd have to go up a little bit against us on this, and we could shift that up if we want, but I'm going to stick with that trade, I think. So I want to get to one more example here. Now, where am I going to get at? Well, I'm going to call this a resistance level, a resistance bounce right here, okay? Right around 590. So I'm going to look to get out if we break above 590. Now, you may be saying, well, 590, that's like max loss, Brent. Well, look, at expiration, yes, that is max loss. But before expiration, it's not, before expiration, you got to look at that purple line here, okay? So we're going to be a long ways from max loss, probably. I can't guarantee it, I guess, but probably. If this move occurs in the next week, then we're probably not going to be at max loss at that point. So I'm willing to do that for that reason. If I want to do that trade, I can create an opposite order, okay? And, I'm actually in the Analyze tab right here, so I'm actually going to send this one here. Well, you know what we're going to do? This is what we're going to do. I'm going to go 590, 560, 540. Let me go to the Trade tab and just show you how you do that. Okay, I'm going to go, oh, by the way, you can enter these in individually, if your spread is single, I mean, you can change it to butterfly like we did on the other, but if you have a single trade, you could say, let's see, it was 590, 560, 540 put. So 590 was long. Click on the ask price. 540 was the middle strike. I'm going to click on, control click on it. Okay. And I need more strikes. And oh no, 540 was not the middle strike. 560 was the middle strike. So I did that wrong. Okay, let's go up here. What if you do it wrong? 590 was a high strike. 540 was going to be long as well. So we're going to make that long as well. And 560 was the middle strike. I'm going to sell that one. I'm going to hold down my control key there on that. Okay. So, and I think I clicked on, meant to sell it. Okay. But what I want to do is I want 2 contracts of the short. So 590 long, 2 contracts short 560, 1 contract long 540. And then for our exit, we said above 590. So I'm going to right click, create an opposite. Hold on one sec. We're going to first change this advanced order to first trigger sequential. Okay. Then I'm going to right click, create an opposite order, this one to get us out, mark it, do the same as what we did before. Click on my gear, pulls up on a window, different screen, pull it over. We said if meta marks greater than or equal to 590, we're getting out. Save. And let me just go up here and see if we can fill that and send that order there. Okay. There we go. So that's how you do that. Okay. So yeah, you can do it either way. Very often on spread, like vertical spreads and stuff, I'll do just go in single one at a time, holding the control key. But you can always change. You got a variety here that you can deal with there on that. And yeah, so anyway, I want to show you one more trade. And this actually is a trade that I didn't come up with. This is a trade I saw another trader do. And again, none of these trades are recommendations. These are all just examples. But I thought it was a good example of a skewed butterfly that actually is a little different. I want to show you a little variation on this trade. And so this trade is on Palo Alto. Okay, they have earnings coming up. Now, the first 2 trades I showed you were short-term expiration. Okay, I think we did September 18th expiration on those first 2. This one I'm going to go out longer. And the first 2 were kind of neutral to slightly directional trades. This one, I'm going to go longer term, okay? And I'm going to go much more directional on this, okay? So how do I do that? Well, longer term, I'm going to choose a longer term strike, longer dated strike. But it has to match my forecast. The last couple stocks, we were saying, well, it may swing up. Here I'm banking on, this, say the 50-day moving average here, that this is going to continue to go up and the stock, which is right here, is going to continue to kind of stay above it. And it's just going to keep on going up. That's the plan on this one here, okay? So this is going to be longer term and we're going to choose a higher strike on this. So As I mentioned, this was not actually a trade that I saw someone else do this trade, but I thought, let's share it with you. So I'm going to the Analyze tab. I'm going to go to PNW. I think I already have it up. Yeah, I have the trade up here. Now let's look at the trade. The trade is this. 400, 450, 480. So where's my target? My target is going to be middle strike, 450, right there, our max gain. If it goes up more and more and more, that's great. But look at my expiration. We're going to the end of the year. Now, some of you may look at this chart, if we look at that chart, and say, let me do this, and say, we got earnings in a couple days. Look, we don't just have earnings in a couple days, we have earnings in 3 months as well. We're going to go through 2 earnings cycles before this trade expires. That's okay. You don't have to avoid earnings. You just have to realize that they're there and be willing to realize that it may move a little bit more. But I think the theory on this trade is, hey, this is a cybersecurity stock, and then bullish on that industry. The trend is up. It can move down on earnings. It kind of did on last time, and then it recovered, and it can do this time. Who knows exactly what's going to happen, but I'm not worried if it goes down a little bit on earnings. This is a longer term trade. That's a much more directional trade. We said our target price was up here, 450. Now, if this were a 1 month trade, 450 would probably be an unrealistic strike to potentially hit. In this case, it goes to the end of the year pretty much. So it gives us more time. So it gives us more time to be more directional on it as well. And when we look at this and we say, well, what's our break even? December 18th. Let me just change my date here. December 19th. I'm going to set my slices to break even. What does that say? 408, I think that says. 408 is our break even. So there you go. Is this a high probability trade? No, this is different than the first 2 trades we did. This is a lower probability trade. We need this stock to go up quite a bit, up to 408. But consider this. So this is very different. My max loss, according to this, is $838. My max gain is up above $4,000. And even if it were to go way up, probably unlikely to go way up here, but that's still over an $1,100 gain on that at expiration. Again, before expiration, the profit or loss can be different than any of these values that you're seeing on the blue line. The purple line is trying to tell you what the prices would be, well, for whatever date I have down here, okay? So if I let's go to late November. Let me just change this to November 28th here. And I click on that. The purple line is trying to model. It's not a perfect model. The purple line is trying to model what the prices would be at that date there, November 28th. And you'll notice, actually, our break-even's down on November 28th. Our break-even's down here about 380. Is that realistic? Yeah, I mean, 380 is right here, okay? Basically where we're, just a little bit above where we're at here. Yeah? So I'm not going to do that trade, but I think it's, well, I don't know. We could do that trade. Maybe I'll do that trade. We'll throw it in. When you right click, I'm just going to confirm and send this. And I'm running out of time here, but I'm going to, actually, I'm going to see if I can get this to fill by moving this over just a little bit, confirm and send, and I'm going to send that order there. Okay, so there we go. So we gave you an example trade on JP Morgan on a shorter term bullish skewed butterfly. We gave you an example trade, shorter term, on Meta on a shorter term skewed put butterfly. We gave you an example of a much more directional, longer term skewed call butterfly that's a longer term date there. Okay. So there's a lot of variety on these trades you can use. You just got to know, tweak the expiration date, tweak the strike prices to come up with the trade that models what you need there for what models the forecast. Remember, you got to come up, first of all, liquid options, come up with your target zone. When you manage, we're not going to hold it all the way to expiration. We're going to get out a week or so before expiration, but we're also going to get out if we kind of hit our zone of our peak zone, or if we have a technical breakdown on the trade. Okay. Thanks for joining me today. Everybody, if you like the session, I don't think there was a survey, but if you click on that like button, that thumbs up at the bottom, it would do me a big favor. I appreciate you. I appreciate James for helping me out in the chat. And coming up next, we got market and sector analysis, everybody. Have a wonderful weekend, and we'll see you same time next week. Bye-bye, everybody.